Thank you so much for joining me. Once again, my name is Ola Ibiwoye of Commercial Property Club podcast, where we serve you with nuggets of information, knowledge in terms of income producing property. We bring experts in the industries, service side of things, and also investors we bring them on board to share valuable experience, valuable information concerning the industry, income properties like apartments, senior living, retail, warehouses, as well as medical building. Today is another day of pod chapter in which we bring somebody that has done it over the years, is an expert in the niche aspect of multifamily, which is your apartment income producing property. Today, it's an August visitor for me, somebody I really respect in the aspect of what he's done over the years also too. I would dive deep into his biography. His name is Dr. Tom Barnes. He's an orthopedic surgeon. He's into real estate. So we'll just talk about, he's the CEO and the founder of Presario Ventures. Presario Ventures is a private equity real estate firm focused on investing in multifamily real estate assets on behalf of his partners. The mission is to bring quality investment opportunities in asset management in service to their private investors also too. As an entrepreneurial real estate investment firm, they focus primarily on transparency, integrity to provide value for their investors, as well as several other sponsors and development partners that partner with them in their venture. The aim is to create a smarter real estate investment by providing a combination of unique debt, equity, as well as wonderful tax structures, your tax shelter. Practically, that's what that venture is all about. Dr. Tom being, like I said, he's a neurosurgeon, that he's an entrepreneur also too. He's retired right now from practice. Has been a physician for so many years in the United States of America. He is the co-founder and also one of the principals in Presario Ventures. I've already gone over what Presario has done over the years. Like I said, they're a private real estate company focused on apartment development, private equity in the Texas and the Sunbelt markets of the United States of America. He has over 25 years of experience in real estate, has acquired, developed well over 500 million of real estate asset, locally as well as internationally. Also too, Dr. Tom is well sorted after author speaker also too. Primarily, he speaks about financial independence for busy professionals and the likes of also to everyday American. His articles is all over of the internet, his podcast-oriented production also too, you can find it online. Dr. Tom also too is a bestseller author. His book, Why Doctors Don't Get Rich, is a bestseller. Talks about a lot of wonderful, valuable ad that creates financial freedom. His mission is to help people create financial independence that can control their future and pursue relatively their passion. Today, I have the privilege to join me here on Commercial Property Club, Dr. Tom Barnes. Dr. Tom, welcome to my show today.
Thank you. I'm honored to be one of your nuggets, and you make me sound a lot better than I am. I appreciate that.
Well, I mean, you know, you've done so wonderful, great things in the industry, and really, they say the proof of pudding is in the pudding. So you've done so much, and it's got to be told. It's a story we have to tell, and you bring so much value to the industry, and I'm glad to have you on board today. And I don't have no doubt that today will be just wonderful and great for my audience in terms of what you would share with us today. And just like I said, earlier on, we today specifically, we want to dive into some aspect of commercial real estate, which is the apartment sector of things today. But the most amazing things about what we're going to talk about today is you being a doctor. So that's why today I came up with this topic that says physician's roadmap to boost returns, lower tax, and build wealth with commercial real estate investment. In this case, we're talking about apartments. So normally I would start with this, that how did an orthopedic surgeon get into real estate?
Right. It was probably by accident. I was, if you've got physicians listening to this or non-physicians, we go, in your training, I started out as an athlete and, realized nobody was ever going to pay me for it. So I decided I'd be a sports medicine guy in orthopedics. So I was going through that training, and there's a period after medical school called residency where you spend 5 or 6 years really honing your specialty. And we're taught by the apprenticeship model, right? So we're taught by doctors that are 10, 20, 30 years older than us. And so they're supposed to be a mirror or a window into what will be us in the next 30 years, right? So this is where the story began. As about the middle of my training, I saw the doctors that were training me, and they were making a lot of money, but they weren't very happy. They were often divorced more than once. They were complaining a lot about their lack of control. They were working hard. They were still in the hospital at 10 or 11 o'clock at night. So I saw that, and that happened enough times. I always tell people it was a touch from God or blind luck, but I just decided maybe I need to look for something extra. I didn't want to look for something different. I just wanted some kind of income coming in that wasn't correlated with medicine. So I searched around and looked at a lot of things and ended up on real estate because of its slower pace, the fact that I could do it with partners, I could do it part-time, full-time. It's just simple math. And so that's how I decided that probably real estate's going to be my thing. And, I didn't have 2 nickels to rub together back then, nor did I have any time. So I just did the best I could to learn. And then when I got out and in practice, as soon as I paid a few bills, I did the only thing I knew to learn about something was to jump into the water. So I just went and bought something early on in my, right after I started practice. And so that's where my real education began. I bought something small, and then I bought a lot of small things, and then I bought larger things, and then ended up with partners, and we bought larger things, and then ran out of money. And then we had to get investors to put their money in. And so our job is now to make them money. And so that's kind of led up to where we are now. I will comment that sounds like a Facebook post, right? Well, it wasn't without lots of trials and tribulations and mistakes and setbacks and lost money and things like that. But that's how I got here. So still not sure how it all happened.
Great insight to how you started it. It always has to start with sitting back and saying that, okay, how do I make a difference in my life? How do I just give myself an advantage, which is what you talked about, right? And looking at what was going on around and paying attention. So
I didn't want, it was, I feel lucky. I saw these guys and I decided I didn't want their money if I had to have their life. I did not sign up for that. I intended to have fun throughout life, and I have, even during the down times, there's always good times that follow. So that's where I wanted to change.
Awesome. So how do you create good passive income with real estate as a physician?
How do I do what?
How do you create a good passive income with real estate as a physician?
Right. In good markets, it's just picking a good project, right? And that's been pretty easy over the last 10 years. But usually it's time and a long view. When I did my first projects, they were it was mid to early 90s back then, but you just do the math, Ola. It's you buy something for a certain amount, you let somebody else use it, and they pay you to use it, and hopefully when it's all over, there's some money left over. So you do the math on the buy. And so that's how I started. And so I would only buy things that provided or were projected to provide immediate cash flow. You could find those deals back then. You still can today. It's just a little harder. And then, you have them managed properly, which typically equates to not me managing it. Professional management, that's a good way to keep the passive income. And then you look at a lot of deals, particularly today. You got to look at a lot of deals to find something that's going to create you some income. And often, or sometimes, maybe there's a year or two wait before that income starts flowing to either build something or to make sure something stabilizes itself. So I know it's kind of a long answer, but that's kind of how I do it to try to assure some sort of cash flow, at least in the real estate world.
Yeah, absolutely. Yeah, you touch bases about the fact doing the numbers.
Right.
It's very important that the education comes in first of all, knowing about exactly what you're getting into to see if it makes sense.
Yeah, you've got it. If you're buying something on your own, you got to do the numbers, and those are pretty easy. And there's all kinds of sheets and forms that you can fill out with all the pertinent information. And if you're investing with somebody else, you still have to put in the numbers and make sure that your math matches theirs. But then there's that added layer of having to make sure that they're competent, honest, integrity, have integrity, that sort of thing. If you're putting your money with somebody else.
Yeah. So, you speak in several conferences, and one of the major things you talk about is financial freedom.
Right.
What is the process of building wealth with real estate for physicians? Because knowing fully well when it's building, it's got to be over time. Am I right?
Right. Has to be over time. I mean, maybe you can get lucky and do it fast. It took me I tell folks it probably took me about 10 years. I started first buying my own portfolio and then buying our own portfolio with partners. And then, so occasionally I would invest in other people's deals. Some were good, some were bad. But my focus at the time, this is right or wrong, I'm not saying this is right for everybody, but I wanted to create income that came in that didn't require my time. And, I was a physician, so I had to see patients or do surgery or take call or do all those things that doctors do, which I really enjoyed to a point. But I wanted money coming in when I was sleeping, vacationing, playing with my kids. So it does take some time. And the way I managed that was to segment the passive income. So I was looking primarily for stuff that created cash flow. And for that reason, I didn't buy land, I didn't buy gold, I didn't go for capital appreciation. Maybe going back, maybe I might do some of that. Some of those fail and some of those have nice wins, but all I wanted was replacing income. And so as I bought a small property that maybe made me $150 a month, or two of them, and maybe it's now $300 a month, I would look at my expenses and play a little game. I always tell people I had everything on a program. It was on Quicken at the time. And I could see at the end of the year by pushing a button that maybe my utilities were $19,000 a year for my house. Well, maybe that's passive income. Maybe I had $19,000 of passive income. I'd tell myself, well, at least I paid for my utilities. Yeah. Then the next was maybe the mortgage or the groceries, step by step. It's kind of eating that elephant one bite at a time. And so it was a game. I could see the progress. I could track it. And then I never kind of ate the golden goose. Any money that came in from my real estate, I kept it in that real estate entity and used it to reinvest. And over time, if you've got passive income coming in, it's, $150 is not going to change the life of a doctor or of almost a lot of people. But it comes in every month, no matter what you do. And it does grow over time with inflation. And then you build up enough and more money from your job or however you make money actively, and you add that to your investment pool, and soon your money starts having babies, I call it. Your money starts making money. And eventually, instead of putting in one amount of money, your investments have made that same amount. Now you've got twice the amount of money to invest in something larger or two properties. And so it sort of grows geometrically. And that's what happened. If you look at an exponential chart, the federal deficit's an easy one. Think of that chart, right? It goes right up to the sky. Well, that's kind of how the real estate passive income went. It just percolated along kind of very slow increase. It didn't look like I was doing much. And then over time, everything just multiplied and that slope went up. And one day I realized I looked at that Quicken thing and I had enough passive income coming in from my investments that was as much as my living expenses. So it was a good feeling.
Awesome. So it's small beginnings that adds up, that compounds.
Compounding is magic. Compounding is truly magic.
Yes. Awesome. So when we talk about tax shelters, what kind of tax shelter strategies do physicians have in real estate investments that you could say, you've
that I've used? Yeah, I remember back in the day, I used to tell people I'd run through the house showing my wife a K1 and how much money I'd lost, and she didn't quite understand it. But that's certainly one way. The depreciation and the expense write-offs that you get in real estate are very generous. That's because the government wants us to build or buy real estate. They need housing, they need warehouses, they need storage, they need hotels, and so they encourage, as my CPA says, tax laws are simply incentives to encourage people to do what the government wants, and they like real estate. So a lot of tax benefits. That offset the income that I made from real estate. And there's a difference, if you're a W-2 employee as a physician, or getting your money as ordinary income, that those write-offs won't necessarily write down the W-2 income. Mm-hmm. But you're still making cash flow. So that cash flow comes in at a very low tax basis, and your aggregate tax rate starts to decline. If for instance, you're at 40%, but then you've got income coming in from real estate, that gets taxed at 0 or single digits or whatever it happens to be. You aggregate that together, and as your passive income grows, your aggregate tax rate starts to come down. That's exactly what happened to me. So I encourage any professional or W-2 person to do what they can to try to increase their passive or portfolio income, which can be written off with depreciation. Certainly over time, the real estate professionals, a real thing. If you can truly prove that that you or your spouse is spending most of their time managing real estate, then the both of you are able to write off depreciation against W-2 income. So that's a very nice tax benefit. And most doctors do know about that, but that's a really good one. So if you're married, get your spouse to be a real estate professional. So, awesome. So that's that. And I hire really good tax people. Yeah. It always seems like I'm paying too much, but then I don't pay taxes, and I realize how much I've saved. So it always works. It always works quite well. But these are not people that just do my taxes at the end of the year. This is somebody I talk to once a month, at least once a quarter. We do planning. If I'm going to buy something, I ask, what's the best way to buy it? What kind of write-offs am I going to get? What's going to happen when I sell it? How do I avoid the recapture? Things like that. You talk to your tax expert, and my guy's really good, and so we do what we can to try to nicely, legally offset those taxes the way the government wants us to. So,
awesome. And that's one of the greatest benefits of real estate, the tax shelter aspect of things, and you alluded to the depreciating aspect of things when it comes to properties, which is also a good take-in when it comes to tax shelter, actually. And also a good CPA also too. Very, very good in terms of bringing on board a good certified public accountant, as you rightly said. So,
well, because there's two kinds of tax preparers / CPAs. One will just do the taxes, and I had that for a long time. They were very good. And as I started learning more, I'd say, "Hey, can I do this?" And they'd say, "Sure," or "No," whatever their answer was. And they'd say, "Yeah, you can do that." And I'd say, "Well, why didn't you tell me?" And they'd say, "Well, you didn't ask." So what you hope for is a tax planner that's going to say, "Hey, Ola, what? I noticed you've got, this piece of real estate. Have you done a cost segregation? You can do that, and that's going to lower your taxes," that sort of thing. So that's what really helps.
Yeah. A team playing and
yes.
Accountant.
Yes.
You surely did that, Yeah. So this question is kind of like pretty much, heading towards the content of your book, how much money does the doctor need to retire? How does real estate help to put them in that path?
All right, so that's almost the bucket pipeline theory, and this is actually in the book. Have y'all ever seen those commercials? I don't know who ran it, but it said, "What's your number?" Right, and people be carrying around their number, which is what they needed to retire.
Yeah,
I'm sure those exist. I just don't know how to calculate that. I don't know how to look into the future 40 years and know what inflation's going to do and what things are going to cost. So I don't know how much money a doctor needs, or a ditch digger, or a homeless person. But what I do know is that if you know what your expenses are, if you know what it costs you to live, and that's those utilities, mortgage, groceries, things like that. If you know what it costs you to live, then that's an easy number to calculate. You can write it on a piece of paper all year, or you can use Quicken like I did. That'll tell you what you spend to live. Then that's your number. That's one number. You try to create enough passive income that comes in, whether you're sleeping, working, or vacationing, and it covers those expenses. Then you are free to do whatever you want to do. That's that liberating freedom and control of your time. So, there's my friend Robert Kiyosaki has a board game called Cash Flow, right?
Yeah. Mm-hmm.
This is not an advertisement for that, but when you play Cash Flow, you draw cards first to see who you are. And sometimes people will draw the doctor card with a big salary and they'll be pretty excited. Somebody will draw the janitor card, which has a really low salary. Well, there's good and bad to both sides, but the janitor has to create less passive income to match his expenses. Granted, he has probably less discretionary income to use. The doctor has more discretionary income, but has to create a much higher level of passive income. So it's different for everybody. It's the amount of your expenses, whether they're high or low. And then, if you'll allow me, there's also another level. There's what it takes you to live, and then there's what your expenses are to have a life. And that's the travel and the fun things for the kids, and doing what you want to do and enjoy your life. So that's my answer for how much people need, because the number's different for everybody. Yeah. But once your income comes in, independent of your actions and your time, you are free to do whatever you want. I tell people you can build your business bigger, travel the world, or sit on the couch and eat Cheetos and binge Game of Thrones. Whatever you want to do, it's your choice, because you're in control of your time.
Absolutely. Absolutely. You kind of like painted the blueprint, actually, and that pretty much, I think that's good enough for anybody to look at and say that, okay, yes, this sounds like a blueprint to building the future that I want.
Well, and I'll tell you, and it sounds real simple, but I've talked to quite a number of people that I'm sort of helping along, and a lot of them don't know what they spend. And it's, the numbers will tell you the truth, right? Numbers don't lie. So
they don't lie.
Really write down what you don't have to write down every stick of gum that you buy, but you know what your big expenses are. And because money, particularly when you're making a reasonable salary, if you're a professional physician or anything like that, that salary hides some things. And so you really need to know what you do spend. And, sometimes that gives you a chance to maybe cut back for a little while if you wish. I'm a big fan of increasing your means rather than living within your means. But at least at the beginning, you need to know that number. You need to know where you are. And that's a huge help.
Absolutely. Absolutely. So how do you build an investment portfolio for long-term success from a physician perspective?
Yeah, I'd stay active in it. I'll tell you, as you said, I've been at this for 25 years. I've got properties that I bought 25 years ago. And, for those that say, well, man, that's 25 years of toilets and tenants, I can tell you, I haven't seen the inside of those properties for 25 years. I've got managers. So I keep those. Obviously, over time, they will pay themselves off, and you can refinance, which is a nice use of the velocity of money. Personally, I've got a little subset of stuff that I just let it pay off. And so it's fully paid for, which is not great money velocity, but it's a nice little safety net, so to speak, in case things go bad. I can always refinance, pull money out of it. Going forward, I try to create or invest in projects that are long-term and have cash flow that grows with inflation, that hedges inflation, which is what real estate does and hard assets tend to do.
Yeah.
Not very little lasts for, 30 or 40 years. And I'm assuming I've hopefully got 30 or 40 years left to go. And so I tend to want to stay a little bit active, always looking for something to ladder on. If I've got what I think is going to be a 5-year investment or 5 to 7 years or whatever, I try to continually sort of ladder another one on top of that.
Okay.
So I'll always have the money working. And then over time they sell. They bring back larger capital appreciation. I will typically roll that forward to save the taxes if I can, or, occasionally pay the taxes. I try not to do that as much as I can, and use that money to buy, maybe I get enough money out of one deal where I can go buy 2 deals. And so I just kind of keep adding to the portfolio, always trying to add some sort of passive income, whether it's through real estate or something else.
Awesome. So the strategy is just to stay active.
I think so. Yeah. And it sounds like it sounds like, oh, well, I'm supposed to be free, right? Well, yeah, you still got to manage your money and you still got to stay active. And I can tell you when, you may have X amount of dollars that covers your dollars or yen or rubles or whatever you're in, that covers your living expenses. Over time that rises, right? And so you gotta kind of keep up with inflation. Often your real estate will help you keep up with that, and your dollars will go along with the expense inflation. But I usually found in my case I had to add something extra just to make sure there was a surplus of passive income.
Awesome. So I've been acquired a sizable portfolio. What are the strategies you can take as a physician for asset protection for these portfolios?
Oh, yeah. Yeah, I read a book a billion years ago called Cover Your Assets, just a little book written by some attorney. But that was my introduction into, hey, compartmentalize your stuff, because I was an orthopedic surgeon. So I'm in there doing my thing. And and so everything was owned, my house and all that's owned personally. So I compartmentalized. I used, if you saw my organizational structure, it would give you vertigo right now. But we create a lot of entities. So I have, personally, I have a certain number of entities, and they have different investments in them. So if it's an at-risk investment, where if I own a property and somebody slips and falls and breaks their neck and puts out a lawsuit, and that lawsuit eclipses my insurance coverage, it's pretty much, just a small amount of assets are compartmentalized into that LLC. So if I did something bad or something really bad happened, they'll just get that. Yeah. Back in the day, they couldn't get any of my doctor income. Properly follow all the rules with the LLC. They're always up to date, and and so that the corporate veil can't be pierced.
Yeah.
Then I have other investments that, I often run my own deals, but it's nice to be just one of the soldiers once in a while. So I invest with people I trust. And in those deals, those are just limited partnership shares. There's no outside risk to those. And so I have those in another partnership. So everything in that partnership is non-at-risk, limited liability shares. And so if something goes bad, I just lose my money, but nobody can come back to that partnership and get anything. My company, we create 2 LLCs for every deal. So there's a management LLC and there's the asset LLC. So, we want to make sure we put a bubble around each project so there's no cross-contamination. So we have way too many entities in Presario, but our investors are protected at least from anything going bad anywhere else.
Yeah, absolutely. The protection of our asset is quite important. What you put in so much effort into, and you find that the litigating fever out there in the States is quite high. So you don't want any of those coming into any of the investments. So like a time like this, Dr. Tom, we have rate hikes, and inflation is obviously rising. And we know obviously the hedging of inflation with real estate is pretty good compared to some other mediums out there. What should a physician be doing in terms of investing right now, looking at the scenario of things in terms of rate hikes and inflation?
Right. And I wish I had, I'll preface this with, I wish I had a crystal ball. And mine's, I tell everybody, my crystal ball is always cloudy. But, I'll start with interest rates have been hiked, but I show a slide often in my talks, or at least recently I show a slide that, if you look at the last 10 years, it looks bad. It's going up like crazy, right?
Mm-hmm.
You stretch that slide out to 70 or 80 years and you see that we're pretty much average. We're at 6% or so. We're what, 5 to 5.25 on the Fed rate. That's not bad compared to history. I bought my first house at 10% interest. It made plenty of sense. So as rates rise, eventually, asset prices tend to come down to match the metrics, right? Now,
Okay.
Currently sellers and sellers and buyers are there's a fair gap between some of them. So,
Okay.
But point being, you can buy stuff at 6, 8. You can buy things at 8% that makes sense if the price is right. It's just a numbers thing. If your cap rate, you prefer to have your cap rate higher than your debt.
Mm-hmm.
So
Mm-hmm.
if your debt's 5%, you'd like to be buying something at a 6 cap, that sort of thing.
Yeah.
But the practical answer is to look at a lot of deals. This is a time when you have to look at a bunch of deals. I have a friend that owns 10,000 apartment complexes, and I was with him a couple of weeks ago, and he said they looked at 14 deals that week, underwrote them. I mean, when they look at a deal, it's full underwriting.
Mm-hmm.
They made offers on 2 and got none. So you have to be picky.
Yeah.
You have to do good due diligence.
Mm-hmm.
If you're buying yourself, be picky at good due diligence, do the math, like we talked about at the beginning of the program.
Yeah.
If you're investing with somebody else, which often physicians and professionals do, do your best to make sure that it's somebody that's got a nice track record, maybe somebody has invested with them. There's been background checks done, that sort of thing. Just make sure you know who you're investing with, and then look at the deal as well. And if you don't know how to underwrite it, find somebody that does. They can look at it, because you can have you can have, like I said, the crystal ball is always cloudy, right? Well,
yeah.
Again, I got a friend that says every pro forma is a lie, which is true, even mine, because none of us know the future. So look at assumptions, assumptions on rental increases. Are they putting aggressive, optimistic rent increases for each year? Are they assuming really high occupancy? Are they planning on selling for a cap rate that's real similar to what they bought it at? Often you want to see an expansion of that cap rate over a number of years, maybe 25 basis points a year. So if they're selling it 5 years from now and they bought it at a 4 cap, you want to see them assuming that they're probably going to sell at a 5 or 5.25 cap. Those little things like that. So if you hit it right, you take the passive income and don't spend it. Don't go buy a Tesla, unless if you want to create that freedom, keep that money in a bucket that's going to be used for investment. It'll add to other monies that come in, and hopefully it starts making babies too.
Awesome. So most assumptions out there is now I'm heading towards your book right now. Most assumptions out there is doctors and physicians are rich. So why is it that sometimes it's the contrast?
So it's it's what is it? Parkinson's principle, right? A bastardization Parkinson's principle. As income rises, expenses rise to meet it. And okay. I'm just as guilty. I saw it happen during a phase of my life. So, those of us that were physicians, really, a really well-paying job. Some are going to hear this and say, "Oh, it's not me," but I think some physicians are not getting paid what they're worth, but still, in the scheme of things, it's a very high-paid professional job. And so, you come out of many years of training and you think, hey, I kind of deserve this, and you do. And it takes an extreme amount of discipline to come out of your residency, which is your training, and still live like a trainee. That's probably one of the best hints is, when you first come out and start making money, live like you're not making money for a while, or as long as you can stand. And all of us are dependent on our time. There's nothing wrong with that. We're just, you have to see a patient, fill a prescription, do a surgery, create a legal document, whatever your profession is, you've got to do that to charge for those services. And no matter how much you charge for that service or your time, if you get hit by a bus someday, music stops. And that's the reason to try to create income that comes in from somewhere else that's not dependent on your efforts. So I guess that title, Why Doctors Don't Get Rich, is kind of a metaphor for the fact that no matter what you get paid, if you get ill or you get crunched by a bus, the music stops and your income doesn't come in. So you want to have income coming in from somewhere else. And so that's why I don't consider somebody, including myself, that gets paid a lot per service as rich. They have money, but they may not be wealthy. And wealth is having the time and freedom to control your time and do what you'd like to do.
True. Awesome. And that brings me to your book, Why Doctors Don't Get Rich. And it's a good book, a bestseller book out there that even Robert Kiyosaki recommends it. Amazing book. And you talked about in chapter 4, developing a rich mindset. You talked about the power of thoughts, the aspect of minding your words, all those money is a tool, all the different kinds of stuff. Can you expatiate more on that?
Sure. And we're all the same. We want to know how, man. Tell me how. Yeah. Tell me how to make that money. I'm the same guy, right? But we all need that foundation. We need, strong buildings are built on firm foundations. And, if you've got the wrong mindset and if you're just after the money, you're not going to be as driven to do something. So if you've got a good reason to create that money, that reason might be, spending more time with my kids, traveling the world, having time to go cure cancer, doing missionary work in Africa, whatever your choice is, maybe the Game of Thrones thing, whatever drives you, that's what's going to drive you through the good and bad times. Because I can promise you, there are bad times. My little Facebook story left out all the bad stuff, and that's where I learned my lessons, and still learning them to this day, right? So it's how you think about life, how you think about wealth, how you think about family. And, there's a number of components of wealth that I like to talk about, but so it is your words, for example, if somebody said, I can't afford that, the words might be, how can I afford that? Or, I make a lot of, I get paid $1,000 an hour, the other mindset might be, I have passive income, whether I work or not, that sort of thing. So you want to use money as a tool. It's not, it's not the end. It is certainly not the end goal. It is a vital tool. Money's, people say money's not the most important thing in the world, but Zig Ziglar said it's right up there with oxygen, right? It's a lot more fun to have money than not have money. So that is certainly a tool we all need, but that buys you the really important stuff, which is, not missing your kid's recital at school and seeing the Eiffel Tower in Paris, or curing some kid from some disease that's simple in the United States but ravaging Africa. So there's reasons, and the mind is really, really important, because you will get beat down. You'll get treated unfairly by either the market or people or bad people or crooks. And you've got to be able to get yourself back up and think, hey, I've got this reason why I want to do this. And that's, this bad person or this bad luck is not going to stop me. And that's really important. So, and some physicians, their goal is just, some of them want to get out right now, which is a shame. I'd like them to all stay in. I'd like them to just love their job and not have to need the money. But that's a big driver for a lot of people as well, just to get out of their current situation.
Awesome. great value add right there. And with your wealth of experience, obviously, I'm sure when you look back to the time you were practicing, you would sometimes pull aside some of your residents, the new guys, the new guys on the block, and give them one or two nuggets. And so, what's your best investment advice for new residents and attending physicians just starting their practice?
Yeah, this is going to sound like self-help seminar, but I tell people work on the mindset thing, and that's you can just kind of make a decision. Yeah, I'm going to do this, but get educated, which means find out about real estate or something else. If it's not real estate, but find out about it, see what you might or might not like, and then go hang around with people that are doing this. Because if you're talking about residents and attendings, they're in the hospital, they're talking to nurses, patients, and each other. And usually the conversation is around medicine, as it should be. We should be focusing on treating patients to the best of our ability. You get around somebody that's trying to grow a real estate portfolio, the conversations are going to be a lot different. You're going to get ideas, you're going to get excitement, motivation, maybe somebody to invest with, maybe somebody to invest in your deals. It will give you that adrenaline shot and that boost, and you'll also learn things you didn't know you needed to learn. A lot of us, we don't know what we don't know, and so unless you're exposed to it, you're not going to understand. Like I mentioned before, people will often say, well, I don't want to buy a single family home because I don't want to deal with toilets and tenants. There's an easy answer for that. And so you just may not know it. So start getting around people, and then, you'll find what excites you, what you like, what you think's going to make you money, whatever, something that you want to, kind of do something, and then, get in there. There's no better teacher than when you got some money on the line. And another bit of advice or suggestion I try to tell folks is, if you're not sure with the person you're investing with or the deal you're doing, try to go in small, because if things go bad, and they will at some point, if things go bad, your loss will be small, but the size of the lesson is the same size. And so, once you start learning your lessons, you start getting some hours behind you and some experience, and you can start seeing some of those things before they happen. You become a better and better investor, and then, be patient, or use what I call active patience, meaning, you can't force nature, you can't force compounding to go faster.
Yeah.
But you can always be looking for that next deal. So you got to stay in the market, whatever your market is, and allow the compounding to do its thing, but do your best to add to that so that the critical mass gets larger and larger, and it'll grow faster.
Awesome. Wonderful value add for the new, I call them the new kids on the block.
The first question is, how do I do what you did? Well, okay, you got a couple hours, you go make a bunch of mistakes is what you do. That's how I got where I am, and good partners and things like that. So it's a teamwork deal. You do a lot better with a team, whatever that team is.
Awesome. You're talking about team right now. As I'm rounding up today, how do you gather your team as a physician investor in real estate?
In part, same way I just talked about, is getting around people that do things.
Yeah. Okay.
You and I might be at a real estate meetup. Those are free. You can
just like we did a few years back.
Exactly.
In Dallas at the family office club that you were talking about. Yeah.
So we're at Richard Wilson's deal. So if you're at one of those things, maybe you're new and you're young and you bought a ticket or something, you wanted to go, but I'd say, I've got my accountant just doesn't help me. Do you know anybody that's got any good accountants that can help me? Or I'd love to find some duplexes. Do you know any brokers? That's how you do it. You start asking people that are doing it. They're not all going to be right the first time, but that's how you find them by try to tap people that already have a good team. Ask them who they would use. I'm constantly referring the folks in my mastermind to good attorneys and good brokers and things like that. So I ask around and do the best I can to try to pick good people. And over time, the team sticks, and it takes a while. Sometimes it takes a few years, and your team has to change too. Over time, you may need different types of attorneys, securities attorneys and others, things like that, asset protection attorneys, stuff like that. So your team will continue to grow.
Awesome. My final question will be about your book. There are tons of information in your book, and when I look at the various topics that you talked about, you talked about several. It's like it's a map. It's a 9-year thing. You dealt with not only real estate, you also dealt with the mind, the attitude, the everything, and which part of it is your favorite?
I wrote that. It wasn't my idea to write the book. Somebody suggested, hey, you ought to write a book. So I did it fully to provide hope and guidance to people that wanted to create their version of their best life, right? So, I felt that I was lucky to be where I was. So, if I can do it, anybody listen to this can do it, and probably better than I did. So if I can stumble my way through and reach a certain level of freedom, then I know everybody else can. And so the guidance part was really pretty much the first half of the book. If you look at it, it's kind of how to think about what you're doing, it's the stuff we just talked about. It's kind of getting your mind in the right place. It's not an Eckhart Tolle book, it's not about getting outside yourself and all that. It's just, here's how to think about stuff. Because most of the successful people I know, that's how they think. They work hard on how they think and the various facets of their lives, of which money is one sliver of the facets of their lives. So I think that's my favorite part is kind of how to think about what wealth means to you, and maybe showing some of the mistakes I made, which was, that's where we get our lessons. So
Awesome book. This it's a bestseller. And finally, I would how do people get in contact with you? You have a blog also to whydoctorsdontgetrich, and also to wonderful book also to how do people get a copy? Can you tell my audience how people can reach you and also be able to talk with you or get a copy of the book?
You bet. So book's easy. You just go to Amazon and type in Why Doctors Don't Get Rich, or my name or something, and then and it's I tell folks I don't make any money off this thing. If you try to make money writing books, that's not what it's not why this was written, and there ain't no money. But so it won't change my life, but it might change yours. I've had some books I've read that have changed the trajectory of my life. So just go to Amazon, and then websites, richdoctor.com. And I tell you, I always ask if anybody's actually read the book, and it sparked something that changed their life, or hey, maybe if they just didn't like the book and have a comment, I'm cool. If they could just send an email to hello@richdoctor.com, I'll get that email.
Awesome. Dr. Tom Barnes, it's been a ton of value today in my show, Commercial Property Club. Thank you for adding value, and thank you for all you do also too. And honestly, it's been an honor to have you on my show today. And as we come to an end, do you have any other thing to talk about before we wrap it up, sir?
Everybody, like I said, I'll just reiterate, you can do this. It's it's kind of a marathon, or it seems like that at the start, but Peter Drucker says we overestimate what we can do in 1 year and we underestimate what we can do in 5 years. I could promise you that compounding's magic. And if you keep adding to your sort of freedom stash and your passive income, you'll start noticing some changes. And you don't have to cover all your expenses. Just a little bit of passive income takes a little pressure off, makes you smile a little bit more, and lets you go to the next stage. So do it one bite at a time. You'll get there faster than you think.
Awesome. Bit by bit, and the race continues. Thank you, Dr. Tom Barnes. It's been a pleasure today with Dr. Barnes here on Commercial Property Club. Thank you for joining me for another podcast episode. It's been a value-add episode today, an interesting topic we talked about today. Having the pleasure of Dr. Tom Barnes on my show today. And it's going to be another day here on Commercial Property Club podcast. Just like I said, we had value in terms of knowledge, in terms of how people get into income producing property and how they can scale up and they can be better. And we're bringing experts. Today was not any different. And we thank you for joining us today. Enjoy a super week as you do or enter into real estate. This is Ola Ibiwoye of Commercial Property Club.